The much awaited RBI monetary policy shocked banks and made NBFCs celebrate. Fixed deposit investors should consider better options like short term bonds or corporate bonds because the rates are going to come down. Two key factors, a zero point 0.5 basis repo rate cut and a 100 basis point CRR cut. This is surprising. Adds pressure on banks' margin in the short term. The RBI stance has been changed to neutral even though there is a room for another 0.25 basis point rate cut in the future. RBI tried to improve the liquidity in the system, thereby boosting the economic growth. However, the problem is that liquidity is already high in the system. But one thing is clear, RBI anticipates a slowdown in the economy due to global uncertainties, including the trade war between USA and China. The projected GDP growth rate is still a concern. The annual growth rate remained at 6.5%, which is not satisfactory for a country like India. This unconventional move by the RBI is to overcome the slowdown by taking appropriate measures upfront. The same scenario is actually true in Europe as well. The banks are cutting the rates. Well, rate cuts are good. Crude oil all-time low is very good. And inflation is below 4% at 3.7%, which is very, very good. But what's wrong with the markets? Yeah, the true genuine concern is growth. FDI inflows drop to moderate levels, and FIs feel Indian equities are trading at higher valuation relative to current earnings growth, so they are selling. But RBI is optimistic about private corporate earnings, increasing consumption, and a above normal monsoon. Growth depends on upcoming consequences, but the RBI has done its job, what it has to do. Every scenario is an opportunity for the investor, so we can look for sectors like NBFCs, real estate, building materials, consumer durables, and auto will benefit in the near future.